Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is the U.S. Mid-Session Brief. Today, we're going to give you the latest from the Iran war. We've got an interesting situation with a very tentative ceasefire. We're also going to look at our Forex majors. We're going to look at a few pairs that are really integral to our trade right now. Great Britain Pound USD, Euro USD. Also gold. We were waiting on that 920 EMA crossover in gold. Did not quite develop for us, but we did get a crossover in silver, and that one's faring pretty well. So I'm going to go ahead and recap that. Also going to take a look at our prediction markets. The Iran prediction markets still very hot. We're going to see exactly what's coming next. We supposedly have some I would call them high stakes. I think I would call them high stakes negotiations. We got some high stakes negotiations coming up here scheduled for Saturday. We're going to take a look at a couple of news items that are definitely the same basic event, but we're going to show it on two different platforms to show you exactly how big the difference is between the reporting. And also we're going to recap the FOMC minutes. Talk a little bit about GDP as well. We had a downward revision to GDP, not necessarily the best thing in the world, but we're going to go ahead and look at it as well. So good to see everybody back. Tina Jin, good to see you out there in YouTube land. Always a pleasure. Andrea Garwell, glad you could drop in, Andrea. Bobby Bob, always a pleasure, Bobby. We've got some pretty good stuff that I think is developing for the next 12 to 18 hours. We've got CPI tomorrow. We had PCE released today. Inflation still very persistent, running about 3%. Those PCE figures are essentially what the Fed hangs their hat on when they're making monetary policy. And then we've also got maybe a recap of the FOMC minutes from yesterday. Very brief, but I'm not going to spend much time on it because it's not really what matters right now. What matters is the geopolitical situation in Iran. There's no question about it. That is what is driving the markets, and we've seen some crazy action today. So let's go ahead and get out to price action. I want to take a look at the VIX because the VIX is saying that we've got some peace coming our way, that's for sure. Kirsty, good to see you. Kirsty, welcome. We could say for almost certain that things aren't quite as dire as they were on Monday. The ultimatum, Trump backing off of the ultimatum after the tough talk after Easter and during Easter really seems to have gone a long way with sentiment. You can see the volatility index. The CBOE volatility index is now beneath our long-term average of 21. If you would have told me that we were going to be beneath 21 and right around 20 as we roll into Thursday this week, as we roll into the Friday session, I would have called you a liar, just a flat-out liar. We were elevated. We were extremely elevated, up around 28. But now you see the markets are getting back to normal. And that's the best way that I could ever explain to interpret and read the VIX, the CBOE volatility index, is that when you see the VIX at 21 or under, people feel pretty good about it. Remember, the VIX price is deferred month, the options contract premiums for the S&P 500. So as those premiums calm down and sort of relax a little bit, then you start to see the market going, okay, maybe we feel good about risk. Maybe we'll take some risk. And right now, that's exactly what you're seeing. Across the boards here in the United States, equities markets are up a little bit. We see that crude oil has done a mid-session reversal. We're still not out of the woods there. I'll go through some crude as well. Maybe we'll try to pick off another TPO trade, market profile trade today. But right now, the markets are definitely responding to what looks to be some good news. And I got to tell you, I don't know exactly where the sentiment's coming from. The ceasefire is tentative at best, so we don't want to get too out in front of our skis, because that is really could be a really big thing, a big mistake to get too optimistic going into this weekend's peace talks. I'm going to have to invest in some new tech. I got my mobile ports just keep going off on me, so I always have to readjust everything seemingly 5 or 6 times during a live stream. All right, good to see you, Jason Maxon. Hey, Jason, how you doing? Fressy, good to see you, Fressy. Mohammed, please add Yurdi or Hindi language. Yeah, I'm sorry, Mohammed. If I could speak it, I would, and that would make me probably a lot more appealing to a lot of folks. I speak English, I speak it quickly, and I barely speak that. So remember, I'll do the best I can to go through the charts and show you the levels, but I'm sorry, I don't speak Urdu or Hindi. That's going to have to be my apology. Tuku, good to see you, Tuku. Welcome, and Ralph H. Always a pleasure, guys. So I speak English. I speak it fast. Sometimes I just talk like a sort of a country boy here out of Montana. So if you don't understand what I'm saying, I understand. Believe me, I get it. I barely understand myself most days. But today, not one of those days. We got a pretty clear view of what's going on. Switch markets. Remember, if you want to trade any of these assets or ideas that we talk about today, head on over to the Switch. They've got you covered. Forex, commodities, indices, crypto, stocks, and also your ETF products. It's all right there. Thousands of them on that MT5 platform. So go ahead and take a peek at Switch if you are interested in potentially getting involved in the markets. Okay, let's go ahead and just get started here with just a quick recap of where we've been this week. Week 15, Iran war. We pretty much could have put that on every single day. Tuesday was relatively quiet except for the brinksmanship and the deadline. That was probably the biggest news day we've seen in a long time. Wednesday was the FOMC minutes. We covered that live. I want to thank you for joining me for that. It was sort of a nothing burger, to be honest with you. I didn't really even feel the need to cover that one live, but we did it. We gave you the lead up and some things to look for. FOMC minutes isn't what you think. We're going to cover a little bit of it today, And then also initial jobless claims today. That was sort of I would say it's one of the bigger releases of the week now, just because everybody's feeling a recession here in the United States. I think if you ask 9 out of 10 people, not economists, but people, most people would believe we're going into a recession here just because inflation's persistent, the jobs market is slowing down a bit. Now, today, we had PCE price index we're going to cover, and then also GDP, so that was the keys for today. And tomorrow, we got US CPI. I'm going to cover that live for you. Nice, bright and early day for me. I'll probably be on the stick at about 4:30 a.m. or so, but that's okay, no problem. We'll be on the air at least 10 minutes before the release. I want to see what these CPI figures say and what they suggest about is happening to our local inflation and also our domestic inflation here in the United States. So it's going to be big, a lot of volatility, a lot of trading ideas more than likely. That's for sure. Let me see, Chris. Yeah, I wish somebody could translate for me as well. We need some translators, or maybe Google. Maybe you can flip a switch on YouTube or something. I have no idea. All right, here's the news of the day. Core PCE price index came in a little bit hot, 0.4%. That's big. Also, year over year, we're right at 3%. That's still elevated. Remember, what the Fed wants to get accomplished with PCE is they want it down around 2, the 2% target, and we're looking at that year over year. You're still 3%, and we'll talk about the minutes in just a second, but a lot of the folks that were in that the Fed meeting really worried about the war driving inflation higher. I think that is probably not an understatement. GDP was another big one. That's what we're going to cover today as our fundamental of the day. Came in at 0.5%. Now, this was the final release of Q4 GDP from 2025. And remember, these numbers are still a little bit disconnected because of the government shutdown has delayed a lot of the reporting. But you can see 0.5%. That's beneath 0.7 expected. And the 4.4%, well, I mean, it doesn't take a genius to see the quarter over quarter is just horrible. A serious contraction there. Still in positive territory, but they revised it down again. And that means that the GDP was really starting to fade towards the end of last year. I won't even venture a guess on what Q1 is. It doesn't look good. Initial jobless claims, 219,000. That is up from 210,000 to 203,000 previous. That's sort of a big deal. We start missing these numbers every single week. then we have to sort of assume when those initial jobless claims numbers go up that the economic contraction's on and U.S. labor is getting worse, and it is getting worse. It looks like it. I mean, right there, week over week, right? But the GDP contraction coupled with rising unemployment and persistent high prices, it spells a really ugly economic situation, one that's going to rear its head if the Iran war is not rectified relatively soon. So economically, I was fairly positive going in. Coming out of last summer, I felt pretty good about it. Not now. I think we're headed for some real trouble, and we'll see. We'll see how it pans out. Personal spending, don't care at all about spending. PCE price index, year over year, February, 2.8%. GDP price index, that's also called the deflator. I believe it's the deflator, 3.7, which is still relatively high. A little bit better than expected there, though. Core PCE prices, 2.70. I mean, it's just, it all pretty much spells one thing. Inflation is persistent. So the news of the day, we're going to cover GDP really quick here, and we'll get on out to our Forex pairs. The U.S. economy expanded at an annualized rate of 0.5% in Q4, revised down further from 0.7 and 1.4 in the preliminary reading. I mean, it's just ugly. A downward revision to investment. So a lot of that investiture that was supposedly coming into the country put the brakes on in Q4 last year. 2 downward revisions. That is not good. That is not good at all. So it's a trend we're going to be watching, especially when the Q1 numbers begin dropping here, which should be momentarily. It should be any time, probably next week or the week after. We'll be monitoring it. But here's a look at your last 3 years. This takes us back to sort of the tail end of 2022, and you can see things aren't good. I mean, you can see 2025 started with a contraction. Not good at all. And then you're starting to think recession, right? And then you get the big hit. So these 2 big rebounds. Interesting that you saw a pretty good set of GDP numbers, specifically after the tariffs went into effect. That this is all last year right here. Tariffs went into effect, and so you got some really interesting numbers. And then you got just the brutal downward revision to Q4 last year. Not a very good year. I mean, if you look at it, you had some pretty good robust action there in the middle, Q2, Q3, but all in all, it's not good. We could argue that these GDP figures were spurred on by that localized foreign investment, meaning money coming into the United States. Heard a lot about that last spring and summer, and Elvis left the building in Q4. So definitely we're going to keep an eye on this trend because it's important to understand exactly what these numbers mean. You don't really trade a GDP. You know, if this is the old pit days, we could say, okay, Shane, how do you trade GDP? You don't really trade a GDP because it doesn't bring enough action to the party. But what it does do, it does give us an idea of the broad trends that are happening. And when you start to see GDP flag, then you're talking about, okay, we need rate cuts. We need lower interest rates to kickstart the economic engine. Typically, lower GDP is going to be lower employment, and there's going to be an impetus to weaken the dollar. Here's the problem. When you have crude oil trading right at 96.63 and it's been above 102 today and the Strait of Hormuz is closed, then you have a real problem with what can you even do with interest rates? What can you even do? You can't cut them. The inflation risk is too high. So we're going to talk a lot about this, but I have to tell you that it just doesn't look very good to me. My economic outlook for this year has taken a major hit. And a lot of that's going to be based on how long the energy prices stay high. Let me see. Pavel, Illuma, NVIDIA Corporation, optical, connecting, photonics, defense, space sectors. Going to the moon, Illuma. Interesting. We'll take a look at Illuma. Let me see. Chris, a quick one. What trading platforms are supported by switch markets? You're going to be looking at MT4 and MT5, sort of the industry standards. I recommend MT5. You've got access to all the markets with MT5 with Switch. You're gonna have thousands. You have way more options than I do trading here in the United States. That's for sure. So you're gonna want to check out MT5. That's gonna be their featured platform. But also, you can get a bridge that's free for all the Switch Markets clients is Pine Connector, where you can connect your trading view to your MT5. I was talking with a trader actually on one of our YouTube videos, left a message, and I got back to him. He said he was using his MT5 robots with Pine Connector and running them off of the alerts on TradingView. And I went, wow. And he just had a couple questions, sent him over to live support at Switch Markets, and they hooked him up nicely. So definitely you can trade anything you really want it. As far as TradingView and the MT4s and MT5s go, I recommend MT5. It's a pretty good order entry platform. It's not as bad. When I first used it, I didn't like it. But it's not bad because you got drag and drop functionality. You got all sorts of things you can do on it. Analytics, I still lean on TradingView for my analytics because it's the best platform out there. It's not even really close, and I've worked with a lot of them. That's for sure. Let me see. Chris, I thought GDP and NFP are related. Well, I mean, theoretically, non-farm payrolls and jobs, as GDP goes down, your NFPs are pretty much going to be weaker. That's what that's what the standard, or the line in the sand really is. It's what it's about when you're talking about the Federal Reserve and numbers like GDP and NFP. The Fed has a dual mandate: pricing stability, right, and maximum employment. Well, the thing is when you start going into contracting GDP, the Fed has a problem. That means that you're not operating at maximum employment. Output is way down. Now, we could have a really deep conversation, and we could be here for all day long, 4 or 5 hours, talking about talking about the AI revolution, artificial intelligence, and the AI really boom could theoretically boost GDP and crush employment. That's very real. We heard it from Jay Powell himself in the last Fed announcements, where he was in his presser, and I sort of undressed him pretty good for it. But he said, well, we got AI's boosting output, not necessarily good for employment, but it's boosting output, and theoretically output is going to promote economic growth. But my point to Jay and everybody on the Fed, and if you're a banker or if you're a venture capitalist or if you're anybody in the business industry or the government, and you're watching this live stream, I'd give you $20 to explain to me how great output and growth means a damn thing if everybody's out of work. It doesn't make any sense. It's the dumbest talking point I've ever heard. Now, AI is a great tool. I use it a lot. When we're talking about coding and getting strategies up and running on platforms, there's no substitute. Get yourself an open AI, upgrade to the plus version, or get Claude or something. Those things can do things that you can't do. I'm blown away by how much it can really help. However, is AI a good thing? I play devil's advocate. I don't think it's a great thing. I really don't. Even though it boosts productivity, who cares if you got growth and you got huge GDP and you got growth, but nobody has a job, what's the point? I got a little extra edge to me lately. It's tax season, and I just had to work through that mess. It wasn't a mess. I know exactly what to do and how to do it, but man, the tax liabilities, holy cow. I feel for a lot of you that are in international locales where your tax rates are a heck of a lot higher than mine. But man, these taxes are immense. They are immense. All right, let's get on out to our Forex and take a look here before we do a little news. Great Britain pound USD, interesting pair. Everybody seems to like it. I sort of talked about this yesterday. Really was disappointed. This was actually not a bad cup with handle, right? Something right in there, but then we broke down, and now we're rotating back up. And I got to ask the question, Shane, do you still like this as a cup with a handle? Not really. The cup with a handle, we weren't guessing. But we're like, it's not the best cup, but we do have sort of that double top formation. So you're there, and then your handle, you would have loved to have seen like a 3-month compression right in this zone. And then we could start talking about maybe getting a potentially big break north from the Great Britain pound against the U.S. dollar. And essentially, back in January, that's what I was thinking. I was thinking the U.S. dollar was going to get smashed. And right now, not really happening. It's not really happening. It's trading relatively strong, even though it's off a little bit today. But the big picture here for the Great Britain pound USD, I'm in scalp mode. I don't really have a direction any longer. There's all sorts of different levels I could pull for you. Probably the best one here, though, if we're just looking for maybe a pop, 15, 20 pips, something like that, you'd be looking at this chart right here. It's a monthly, not the best Fibonacci retracement sequence. This high, 138.70, down to this low, 131.61. And now we're sort of rallying. I would be looking maybe to sell 136s, looking for 25 pips, 30 pips. Very, very conservative, though. I'm not interested in taking a position really in anything right now because of the war. But that is sort of the line in the sand for me. I think if you break above 136, then we're going to head much, much higher. CPIs tomorrow. We've got big announcements on the way. Typically this weekend, 136 could come into play a lot sooner than we think. So check out the Great Britain pound USD. That's a pretty good one to be watching. We're covering all USD pairs right now. We sort of missed this Euro USD, didn't we? The daily, we had this one lined up, and we were ready to rock down there from about 116.40, somewhere down in that zone, and the low came in at about 116.50. We should have just been aggressive and bought 50s and gone with it because that's been a fantastic move for about 68 pips. as of right now, what could we really do with regards to the Euro USD? We've got several systems, several strategies, several ways that we can play it. The bigger thing I would be looking at right now, you're up 0.5%. Could we find a resistance level potentially up ahead somewhere, up the road a bit? And we can. It's just not that great. I mean, we have to be honest about what this war has done to our market dynamics and what it's done to our technicals and our ranges and all of it. Right now, things like Fibonacci's, they're still strong, but they're not as good as they can be. They're not functioning as good as they can. When we're in situations where things are a little more clear cut and price just ebbs and it flows, and you don't have an artificial stimulus hitting the board seemingly every 3 or 4 hours, then we have a real chance to win, especially with your 38% and 62%. You could almost trade those religiously and be okay. 50% is a different story, and 78 rarely comes into play. But something like this, what do you really do with it? I mean, you go right up to this spike high. We go spike high here. You go spike low there. What do you have? Do you have a resistance zone up there? Yeah, we got one. About 118 and a quarter, about 100 pips up the road. That's pretty much a target-rich environment if you're looking to short this. But once again, we're not taking positions. I'm not going to sit here and say, okay, I'm long or short the Euro USD. I'm nothing right now. I'm waiting. I'm waiting for that 118 and a quarter, maybe 118.09 if I want to be really aggressive to come into play. Step up and short that with a limit and maybe look to get 25 points, 30 points off of it. You certainly could do something like that and be very, very cautious, of course. That's sort of the word of the day. It's been the word of the week is caution. But that's a pretty solid level. I like that one. We're going to go ahead. We're going to look at something for the Euro USD here in a second, though, that's a little bit different than that. This right here, though, dollar yen, this is what's the strongest play on the table, Shane? What do you think the strongest one you have is? And I would say weekly chart, weekly Fibonacci retracement sequence, dollar yen. I really like this one. I like it a lot. I think this one's a pretty good one. 38% is down there, 157.31, and then we've got the 13-week EMA. That convergence right there at 157.36, that's a big deal for me. So right now we're trading 158.70. We're not there. We're still, about 100 pips down the road, 125 pips. We could get it, though. We could certainly get it. So we're watching that closely, especially with CPI on deck tomorrow. I think that's a fantastic level. We've got pretty good levels to play the majors with. Like I always say, I don't know, if you're going to play the pound, the Euro USD, and the yen. I don't think it's a bad idea to take all of those trades or consider each one of those trades. But what you have to do is make sure that you're not taking them all at the same time, because if something crazy happens with the dollar, you could lose all three. You could win all three, but you could also lose all three. So you want to be careful that you don't have double and triple exposure. This was an interesting 920 EMA crossover from that 75 level, which was sort of a big deal for me. I outlined 75 in silver, spot silver, the XAU USD. And what this means is that the market is sort of broken above 75 and pulled back and is now rallying again above 75. Now, silver and gold have everything to do with the strength of the U.S. dollar. We have never seen, well, that's not true. We've never seen, I would say, as aggressive of a correlation between the dollar and metals. Now, they're always correlated. Typically, the stronger the dollar is, the tougher it is for metals. And then when the dollar gives some back, you really see metals go for a run. It is almost an instant correlation now. When the dollar's down, metals are up. That's almost guaranteed every day. Now, for me, I'm watching this, and we were talking about this a couple days back. I said, you get this crossover to develop here on the silver market. And this is a 4-hour chart. I like the 4-hour chart on gold and silver. I think it's a strong time frame. I think you can make a lot of plays here, but these trades do turn into swing trades. That's for sure. So you've got the nice big rally that broke out, basically a bullish break back on the 7th of April, and then we got up here. We didn't quite go up over 78, came back down, and now we're back above 75. So we're still sort of straddling that 75 level, which can make it really tough. It can make it really tough because you're like, I don't know if we're going anywhere. But one of the good things you have with a trade like this is you've got an opportunity potentially to get a buy there, and then you know exactly where your stop loss has to be. 2 options. Right there, you got stopped out. I like the previous swing low, especially if you're working with a market read where you want to try to get in on a big move. You want to give it every opportunity to get in on the move. And so when we see something like a silver and you're going, okay, if I bought in right there on this close, right when the 9 crossed over the 20 and then right on that bar close, and if you bought from there, okay, you're 76, so you're about up to break even. You're still down a little bit, but you've taken a lot of heat and now you're rebounding. So, the trade's not over for you yet. But let's say you're down in here. You put it right beneath your trigger bar just by a few pips, and then you get nailed. I mean, this is textbook trading, guys. I mean, this is trading 101. When you see something like this, there was a little gap right there in that market, a little bit of a gap. And what happened? The market came down, checked out the gap. It would have stopped you out, and then it rallied. So you've got to be very careful when you play these types of strategies really tight. You want to give it time to move. You really do. You want to give the momentum time to kick in. And this has been a swing trade. You'd have been in this for a couple days now. I think it's an interesting play. We're going to wait and see. As far as what could you really say about your profit target, you got to be looking for 81s or so. If you took the position here, you got to be looking for 81s. Typically, that's going to be the ticket. Your stop loss, let's say it's down here, somewhere around 69, 7. So you're probably looking at 83s, somewhere up in there. That would be the trade. Is that possible? Maybe. You can always tighten. You can always tighten up to there and then just try to take a trade like that. I don't mind that either. But with silver, there's so much juice in these markets. It feels like gold's going back to 5,000. Silver, it feels like it's breaking above $75. So right now, not bad. Kanu, good to see you. Kanu, welcome. I don't think I speak the language, but hey, welcome to the room. If you can understand me, great. If you can't, that's okay too. So that's a pretty good look at silver. I do want to throw the Euro USD on this chart as well because you can see with a 4-hour, absolutely killed that this one did. This was an interesting little rally, that crossover back on the 31st of March, and then you got the sell signal. You got some good bullish price action there. Good bearish price action. Be bullish for your bank account if you were short. You got a nice little move there, and then the rally, and then the crossover, and then you get in on the big move. So if you're going to trade crossover strategies, I typically like to approach things with a one-to-one fashion. That's me personally. I like to get in. I like to play relatively tight and then look to take my profits. But let's say you aren't, and you're looking for big moves. Let's say you're looking for decent moves in something like the Euro USD. 4-hour chart, you see you got to sell right there. You've got to buy right there. You got to sell right there. Basically, you'd lose that one. You don't quite lose that one, but you don't make much money. And then maybe you take that one and you get out. You get the big move there. Then you have the buy there, which still stays live theoretically. And then you got a short. What I'm trying to say is as soon as you start seeing a lot of these trading opportunities set up with a 920 crossover, you got to be sort of skeptical. You have to be sort of skeptical about what's happening. It means, this market doesn't really have a direction. And you can play them all. There's no problem with that. But if you play them all, more than likely you're going to have that one of those bigger risk versus rewards where your winners are going to outweigh your losers. Remember, if you take a couple of small losers and then a big winner, you're still profitable. I mean, you're still in the money. Personally, that's not really my style, but a lot of folks love that. They love that strategy. So it's really up to you to design your risk versus reward in whatever you need to do to be successful in your own mind. Remember, it's all about no conflicts. You can't have a conflict. You can't sit around going, oh, God, I was so stupid, or that was stupid, or this strategy's stupid, I don't understand it. Can't be like that. If you're going to succeed, pick a strategy that you like. Pick a risk versus reward that you like, that you agree with. And as long as you have that, then you're going to have an opportunity to succeed. If you don't have that, it's a matter of time before you lose. That's all there is to it. Now, one of the things I like for the Forex, I do like the 4-hour chart. They're true 24-hour commodities. Well, they're not commodities, but they're true 24-hour products. The daily, what do we have going here? We got a buy. We got a daily buy setting up for your Euro USD. Fascinating stuff. You got to sell right here. Pretty good move. Essentially on a short position, this is how this trade would have looked. And feel free to check out some of the videos that I've made on the 920 crossover, something like that. Well, we're not getting any love there. In any case, could have been your sell there. Boom. Stop loss should have been up above that swing. So what do you had, a 1-to-1 there? Maybe even a 1.5-to-1 or a 2-to-1. That's a pretty good move. Pretty good bearish move on a daily. Now, Got a bullish crossover setting up. So where would you put your stop loss in this instance? Two options. You can put it right beneath the daily low if you want. Sometimes you get chopped out of those, though, before you get your big move. Probably right in there. Right beneath this 3-day run. What do you have there? What is that chart pattern right there? I don't think the close is high enough on the third candle. What is that? 3 white soldiers, I believe. Something like that. In any case, there it is. There's a rally. There's a crossover. That's setting up nicely in the Euro USD. So if you were to take this trade and take this position, what do you have to get out of it? Well, your stop loss, you put it right underneath 115. Basically, you're risking 200 pips. You're going to need to see some 119s to make that even worth showing up. Is it possible? It's very possible. It just depends on what happens to the U.S. dollar. You're going to need the war to end. You're going to need the war to end to get that trade to come in. You're going to need a ceasefire, optimism, all that. Right now, it's going well. But as soon as the bombs start flying again, the Strait of Hormuz closes, you're right back to square one with a strong dollar, money going into T-bill yields and things of that nature. So you've got to be smarter than the average bear. That's for sure, especially in these conditions. Right now is a really challenging time to be taking positions based on fundamentals because you don't know what they are. If we weren't fighting a war, I'd say fire away on that, buy it. Because that would set you up for a potential great swing trade. The U.S. dollar, the Euro USD, really is in position to make a run at 120 even. But we're just the war is killing everything. No dirty pun intended there at all. It just really is a negative market driver for a lot of these products, things that we could really nail before. When you get the war involved, you can't really do it. And it makes things really difficult to try to figure out exactly how to game plan for it. There's things called unknown unknowns. There's always uncertainty. When you're in the market, there's always uncertainty. That's why we talk about risk management. Risk this, get that, all that stuff. We talk about it every single day. That's how we manage the basic uncertainty of the markets. But then there's unknown unknowns. And unknown unknowns are we don't know what we don't know. And you got to be very careful with those because we just don't know how this thing could pan out. I could give you a bunch of different scenarios. I don't want to because most of them are depressing, but there are a few scenarios out there that are pretty good. However, we have to be sober with the way that we look at the news. I get criticized a lot for just showing NBC, CNBC, and NBC. The reason why I use these news outlets is because they're free, and you guys have access to all of it free, so I don't have to pull up a paid service and say I don't have to have a paid service in front of me to sort of vouch for the validity. So what I'm saying is you guys need to be able to fact check everything I say here. And so what I'm going to give you some headlines, and then we're going to go from there because the truth is always somewhere in the middle. You're going to get headlines on this side, you're going to get headlines on this side, and the truth is going to be somewhere where this microphone is typically, bottom line. So what we're going to do is look at a couple of stories, and then we're going to look at our prediction markets, talk a little bit about FOMC, and if there's any markets you guys would like to look at all, feel free to throw them in the live chat. Let me see, I have a question here. Ralph H., does that candle wick make you pause at all for the 920? Let's see. This one? No. Not really. I think the best way, if we're talking about this trade, Ralph, this play right here, if we're playing a crossover, you remember your conventional entry on these crossover trades is just going to be at the daily close or at the periodic close when you get the big gold bar to line up. And if you haven't seen this one, it's over on the How to Trade YouTube channel. Just Google 920 or 920 EMA crossover strategy. The coded 920 EMA crossover, and all my code and everything is included, so you get this already coded for you for free in TradingView. Yeah, so the wick here, you're right about this. You had a big spike, and now you're sort of filling in this wick. It does stand to reason that is this market going to go straight up? Probably not. Markets typically retrace, and for me, the way to trade this would be to wait a little bit and run a Fibonacci. Maybe if you had to wait another day, even if it stopped here and you retraced, you could get in maybe down in here somewhere off a nice retracement level, or you could wait for your moving averages to sort of catch up, wait for a pullback to that 9 EMA. You can see that, that happens almost religiously. Look, almost every one of these things pulls back to the 9 EMA. That could really help you improve your entry. So this wick right here, clearly we had a thin chain up there. If we want to look at a 30-minute chart, it'll show us 30-minute chart from yesterday. So essentially, boom, there's your big move. We didn't even really fill that in. That's from back on the 4th. A little bit of rotation, big pullback right there on the 8th. And now we're just moving sideways. It's all news-driven, Ralph. So to me, I'm not going to worry about the wicks too much. If this was normal trading, you've got a great point about that upper shadow from the previous day being a problem. Also, you could make the argument that the close of this daily bar, if we close right at the top of it, it's like, that's not a very good entry. And you're right. So maybe you wait for this thing to set up. Maybe watch it play out for a couple days. Maybe you go in on Monday. Of course, if you do that, then you risk missing the move. And I don't want to see you guys miss the move. So we put that out there. Lots of different ways to trade it. That's for sure. Personally, I like that idea, though. Daily crossovers are pretty strong. They're pretty strong. All right, let's go ahead. Take a look at these news stories here. I guess we got a little sidetracked there. This stuff right here is going to give you two different views. Fox News, here you go. U.S. military loading up and resting, Trump says, as Iran tests ceasefire. So U.S. and Iran are under a fragile ceasefire. Thursday's parties negotiate a wider deal. Iran's threatening to bail on the ceasefire already because of the major strikes in Lebanon. What we need to know right now is the Strait of Hormuz essentially is closed. So go on over to CNBC. They didn't tell you any of that at Fox. They didn't tell you the Strait of Hormuz is closed. CNBC, they're coming right out with the bad news. And that is all about the Strait of Hormuz is not open as Iran controls access after ceasefire, UAE oil CEO says. So right now, they're not planning much of anything. The bottom line is there's supposed to be a meeting this weekend with the vice president. They're supposed to meet with some representatives from Iran, or believe me, or a representative out of Pakistan who's a go-between between the United States and Iran. So you add all this up, and nobody knows what's going on. Bottom line is this. It's a tentative ceasefire. It's a delicate thing. It could break at any minute. The bombs haven't stopped. Israel's still bombing Lebanon. Iran does not like this, so they've shot some bombs off and have effectively closed the strait and are talking about charging a toll on letting anybody through it with a tanker. So that is sort of where we're at. The U.S. oil markets show you the angst. You can see right here, weekly chart, nice big explosion, that's where your war really started getting crazy. And then we've traded inside of that week from the 9th of March ever since. So what we've got here is we've got a situation where potentially we're going to break. Something's got to give. And we're either going to give to the top side or the downside. For me, the downside is going to be a peace deal. If they come in with a peace deal or establish some sort of toll structure, I mean, the tolls being floated right now are $2 million a tanker, or $1 a barrel. Some folks were talking about $1 a barrel on each barrel of oil that goes out of there. An oil tanker, a $2 million tariff or a toll to go through the Strait of Hormuz sounds big. Some of these oil tankers are worth $1 billion, more than that. So when you start talking about the game on that level, does a $2 million toll, essentially, is it a huge deal? And it's clearly a big deal for Iran. They would love to raise the money for whatever reason. But is that doable for the rest of the world? It may not end up being 2 million, but maybe 1 million, maybe 500,000, maybe 750,000, maybe 1.5 million. Something like that it could definitely be how this war wraps up. They may just say, okay, we're going to reopen the strait completely. Here's the toll to go through. I think that a lot of that would be acceptable on a certain level. You would pass through those tolls to the consumer. So U.S. oil, U.K. oil, whatever, is going to be worth just a little bit more because it costs just a little bit more to get it from the origin to the market. That could definitely happen. And right now, we're looking for off-ramps. Everybody involved is looking for an off-ramp. I believe that. I know in the United States, Trump's looking for an off-ramp. He wants to see something resolved and get this done and over with before the summertime here in the United States. It's an election year. So is that doable? Well, the markets are kind of on the fence today. They're like, It's an interesting idea. Oil still is off about 0.5%. We'll go ahead and pull up the intraday stuff here in a second, but this weekly chart shows you that even though there was some brinksmanship that took us up to about 115 or 117, it looks like the oil traders and the oil markets believe that you're going to see cooler heads prevail, and this is a pretty good sell-off. 15% for the week for U.S. oil. Not bad at all. Take a look at today's 30-minute chart. Sort of a look at U.S. oil. What did you have? Huge rally. It was gaining steam up there right around 102.70. That was early U.S. session. People were beginning to really get down on the idea of, oh, man, the strait's closed. What's that going to do? Now there's a lot of optimism. I mean, we've come from about 102 down to 95, 96. Purely news-driven. 100% news-driven, no question. Point of control for today. I've been talking a lot about the point of control over the last several weeks because when we have news events and we're running and we're rotating and we're going to a certain level and then setting up a value area in a range, I find that these ranges and points of control where the majority of the business has been done is extremely important. It's more important than probably your Fibonacci's right now, in my view. I think that you're seeing these markets, I mean, it sounds crazy because the ranges are so big, but they're starting to normalize a little bit. I think the market's kind of cool with oil trading at right around 100 until this thing gets sorted. Now, what do you have? Well, you got a situation here with a point of control, late day point of control, 97.50. Probably a pretty good trade if you can get it. We just need to see a little bit of buying and then maybe selling that area for the next hour or so. Probably a pretty good idea. We did something similar yesterday. Hit one pretty good on oil futures. But the big picture is I'm not really going to hand out any macro levels for oil. I've gotten away from that in the last several weeks because the news is driving everything. The news is driving everything. We don't know where this market's going to be in 3 hours, let alone 3 days. So we're going into a news cycle that's supercharged. Essentially what's going to happen this weekend is there's going to be negotiations. And unless those fall through and unless nobody sits and talks about it and puts out maybe some compromise to wrap this thing up, then we're probably on track for more escalation next week. Remember, it was only a 2-week ceasefire. Trump's sort of getting back, rattling the saber, saying, well, we're refueling, we're restocking missiles and things, and that's exactly what's happening. So I don't know. Nobody does. Nobody knows how this one's going to pan out, but it's interesting where we're at. Position we're at. Let me see. Lebo, good to see you, Lebo. Welcome. Hey, how you doing? May I ask, how does the ceasefire impact the markets? Just like that. The ceasefire right now has brought some optimism. There's no question. The VIX, the volatility index, is down beneath 21. That's huge. That suggests that a lot of people believe that this thing's winding down. We've seen equities. I mean, equities have had a pretty good week. Let's go over. Let's just look at the Dow Jones Industrial Average right here. Looking at the last month, it's been a pretty good April for the Dow. It really has been. Today, last couple of days have been pretty good. So this ceasefire has been big. We have 36 hours of ceasefire, something like that. So 36 hours, and you're looking at what, a 2% gain, so you're up about 3.5%. It's been pretty good for equities. As far as the U.S. dollar goes, here's a good look at the DXY. The DXY is gapped down. We talked about this gap yesterday, potentially being filled. Well, it hasn't happened today. So there is optimism in the markets. The ceasefire is bringing optimism and stability. There's no question about it. Long-term average and that VIX volatility index is down. The one that we're just really talking about is U.S. oil. You know, where's U.S. oil been for the last couple of days? Well, that's a much more complicated story because we feel like we're sitting on a powder keg here. This is the straw that stirs the drink right now. Oil is dictating really everything. When it's down, stocks are up. When it's bullish, stocks are getting pressure. Not as bad as it was. The reactions aren't as bad as they were earlier in the war. But the dollar, all of a sudden, there's a correlation with the dollar. There's a lot going on here. There's a lot going on. So when we look at U.S. oil for the last couple of days, you can't really argue with this being a very positive period. The last 36 hours have been positive according to that ceasefire. So even though I believe it's tentative and we're not even close to being out of the woods, there's a lot going on. I think it's really fickle and tentative. I think it could all turn on a dime. So that'll be my answer, Lebo. That's for sure. Let me see, 1906. Good to see you, 19. Hey, Shane, can you point me to where the code is for your 920 indicator? I love watching you use it. Thanks. Yeah, it's Now let's look it up real quick. I'll show you sort of the How to Trade YouTube channel, and maybe I'll drop a link in there. Yes, this would be the How to Trade YouTube channel. You can see we're live right there, so that's absolutely fantastic. You just go to videos here, and then you go to coded, the coded 920, where you got the little AI guy. So this would be the video, essentially. Copy it, and I'll just drop that in there. And you can actually find the code. The code's down in one of these replies. I think it's in this first one. So just go ahead and go down, and I've got the code's in there somewhere. So you can definitely find it there. I'll go ahead and drop it in there. Let's see, a question for the NQ. Yeah, we'll go ahead and pull the NQ here in a second. We got to talk a little bit about yesterday's FOMC minutes. Hope that helps. 19. Let me see, Eli, Shane, did you ever look into the variable range volume profile to compare with your indicator? I didn't get a chance, Eli. I'll write a note, and I'll look into it probably in the next week or so. I'm going to be sort of on the go traveling for the next few days, but I got to write that down. I got to look at it. Variable range volume profile. Have to. Let me see, NQ. Yeah, we'll look at the NQ in just a second and close with that. This is a good look at what we have from the FOMC minutes. I covered this live yesterday. I want to thank everybody for showing up. Didn't really get into the actual event itself because it's not necessarily it takes a while to do. You got to sit down and read it. Essentially, FOMC minutes show the Fed is worried about the impacts of Iran. We talked about that. And viewing a rate hike as likely as a cut as risks become increasingly two-sided. You really don't need to see anything in the article. You don't have to read it. The headline tells it all. Here you go. All told, real GDP growth was expected to run about in line with potential growth through 2028. As a result, the unemployment rate was expected to remain near its current level and then edge down to the staff's longer-term run of employment. Forecast for inflation for this year was slightly higher on balance than the one prepared for January, primarily reflecting incoming data and an expected boost to consumer energy prices given the recent run-up in crude oil prices. Notice how they're talking. Inflation was projected to return to its previous disinflationary trend and be close to 2% of the year, but now there's a war and yada, yada, yada. So the bottom line is this. There's a problem. The Fed is sort of, in a lot of ways it was the biggest present the Fed could ever get was the Iran war, because now Powell doesn't have to do anything. He can just say, well, we don't know. Bankers are great at this. Believe me, they don't know much. I'm just kidding. If you're a banker out there, I'm just hacking on you a little bit, but when it comes to central bankers, one of their big jobs is just to never say anything that means anything. And that's basically Jay Powell's job, as he tries to tap dance around the obvious and not really tip the markets off to create undue volatility. So the war, in a lot of ways, was the biggest gift they could ever get, biggest gift Jay Powell could ever get. Let's say the disinflationary trend continued, and it did keep coming down to 2%, that goal that the Fed has. What happens then? Does Jay really want to cut rates? Hell no, he doesn't. He's going in front of the DOJ still on potential perjury charges over what's happening at the Fed headquarters and that remodel that's $2 billion over budget or whatever. He's not going to cut interest rates to help the administration. So this war is like a gift for the central bankers. They don't have to do anything. They just go, well, the data's still out. We got to make sure that the inflation's under control before we do anything. I can already see it. And that's where the calls for stagflation that I've been making a long time come in, is when you start talking about, okay, inflation's persistent and you don't cut, and now unemployment's rising, which we're seeing in the numbers. GDP contracting, unemployment's up, prices are up. It's a mess. And you need to cut interest rates, but you can't because of the energy shock. That's why this Iran war it's the straw that stirs the drink for everything, for absolutely everything. All right, let's take a look at the NASDAQ. I will look at the US 100, and then I'll pull up the futures contract. As far as what we have here is a lot of relief. NASDAQ likes the ceasefire. We're going to get that helium. Helium's going to get back going through the Strait of Hormuz, and we're going to have more semiconductors, more AI, you name it. Here it comes. Well, Maybe, maybe not, but it's been a good week. No question about it. The ceasefire has been a big one, though, for the NASDAQ. And so now we're just rocking and rolling up towards the top of sort of your value area here. I don't know. That's not a real great area to target. Let's go to a monthly. We had this one outlined pretty well. We just didn't quite hit it. The low was 22,779. We were down there at 22.5-ish, 22,454. Big time rally up above 25. So what's back in play for the NASDAQ or the US 100? 25. Just mark it on your chart, 25. That's absolutely key. The reason why is we're back at a known value area. We're back in a known area, an area where a lot of folks like to do business. We've done a ton of business on that 25 area. So let's go ahead and take a look. Let me pull up the NQ. What are we on the June contract? I haven't had NQ up in a while. Well, that's a continuation contract. I don't like those. NQ June. Big month. 5.5%, right? Interesting. Let's go down to a 30-minute chart and see where we're at. Get some TPO action. Broke out of sort of yesterday's value. POC is way down here. Way down there at about 25.29, and we are trending higher. I mean, this futures contract is screaming peace. It's screaming there's a peace deal. It likes the peace deal. If I'm trading this one late in the day, well, I mean, we're starting to get, it's not quite fully set up, and this is a little different than crude oil because you've got about 2 hours and 13 minutes left of the session, but you're starting to see that B formation that I love so much. It's like an uppercase B in the English language. This chain in here is pretty thin. Typically, that means you're going to come off and fill it up, maybe revert back down to the point of control towards the close. Yeah, that's interesting, isn't it? So if you're doing all this volume and all this business and we're driving higher, right? Take a look at where all the volume was. Right down in here during the overnight. I wouldn't really count that too much, but take a look at where we're at. The bidders stepped in, rallied us bit way up. So this area right in the middle of our B, our void, it's pretty thin in there. So the question is, and this is what a lot of day traders are doing right now. I mean, this is something that pretty much everybody's considering doing. How do you capitalize on this? What would you try to do? Are you really trending here? Not really. E-mini NASDAQ, what are you up? 0.75%? You're not trending. It looks like a trend, doesn't it? It's still a B formation. Is the pressure up? Yeah, the pressure's bullish. Why? Optimism. Could that fade? Yeah. So what are a lot of traders doing right now? Day traders, as we get later into the session. There's a lot of shorts in there. Stop loss is up above value, up above the daily high, something like that. And then that profit target is right down there in that void. Somewhere right in there. That's a potential day trade. Now, ignore the numbers. That's 4 contracts, and that's a lot of money to be playing in regular size NASDAQ trades with. No question about it. But when you start to look at the way that this market is set up, you'd say, okay, there's the high. I would look at it more along the lines of Fibonacci's. I'd say, okay, spike low there, spike high. We're still well above 38%. That means we're bullish, but are we trending? No, we're not trending. It's not a trend. And the reason why I say it's not a trend is because you're only up about, 0.8%? We're not even up 1% yet. It's a pretty good move, but yesterday was a trend. Yesterday was a 3% gain, 2.5% gain. Given this news environment, we could easily see this price action slow down and gravitate back down here. And one last thing I'm going to say about the intraday stuff for the NASDAQ. It's not an accident that point of control is down there near 25,000. That is not an accident. Very, very, very serious chance that we rotate down late in the day. Now, of course, if you just took this trade and you're looking at your DOM and you're going, shit, I'm already up $540, like 660, 740. I mean, you could just take the money right now, right? Well, that's another discussion for another time, but the trade's definitely going our way. There's no question about it. No question about it. All right, everybody. I'm going to go ahead and let you go. We'll save the poly market prediction markets for tomorrow. I think that what we'll see is that's a better time to do it. We'll go CPI, cover all the latest in the inflationary situation. We'll get in there and trade something, and then I'll also take a good look at what our expectations are for the weekend. Look at this trade. Look at this trade's got legs. Well, we're already up $1,000. This is all funny money. We're already up 1,100. Take it. Nothing wrong with taking a profit and running. Ring the cash register. Move on to the next one, right? Yeah, we got a pretty good idea on futures. I've been trading futures for a long time. A trade of that size, though, come on, you'd be risking $3,400, $3,500. You need $100,000 to make that trade. You need $125,000 to be serious and make that trade, and that's what most day traders have. If they're serious ones, realistically, to make a trade like that, All right, everybody, I'm going to go ahead and sign off. You're welcome, Eli. Okay, guys, I'm going to remember the big thing that we have to look at definitely is anything, and I mean anything, to do with the Iran war. Any ceasefire, if there's a surprise attack out of the United States, which I don't put anything past Trump at this point. He's trying to get his way through negotiations, and all that's great. But if things escalate and they start to go a little bit off the rails, the first thing that'll tell you that is going to be your oil markets. That's for sure. Watch your oil very closely, because if it does spike, it's going to spike and probably run. Right now, we're finding a little bit of stability there, right around $96, 96 and a quarter. Any bad news, and we're right up around. We were at 102 earlier today, so we could easily be back up around 100 by the close. I'm not sure. A lot of optimism out there today, though. A lot of optimism, and that's sort of new. Still watching the news cycle closely. All right, everybody, I'm going to go ahead and roll out. You guys have a fantastic session. I'll be back tomorrow, 10 minutes before the CPI starts at 8:20 a.m. Eastern, which is 6:20 a.m. my time. Money never sleeps, and tomorrow it certainly won't. Have a fantastic trading day, and as always, trade the action well, and we'll talk soon. See you.